It's John Observation here. Silver just delivered one of the most violent reversals we've seen in years, and if you're only watching headlines, you probably missed how important this move really is. In less than 24 hours, silver surged more than 22% off its lows, moving from the mid-60s straight into the high 70s. As I'm recording this, Western spot silver is trading around $78, while Shanghai spot is even higher, above 82. That alone should already tell you something important. Moves like this do not happen in calm, balanced markets. They happen when pressure breaks, when leverage snaps, and when physical reality begins to overpower paper positioning. Spot silver briefly printed above $77 an ounce within minutes, already up more than 20% from the recent low, and then pushed into the 78 area. This wasn't a slow grind higher, this was a violent snapback, the kind of move that catches traders completely offside. And silver didn't move in isolation. This reversal happened across every major risk asset at the same time, which is critical to understand. Bitcoin surged more than $11,000 in a single day, reclaiming the 70,000 level. Ethereum jumped nearly 18% off its lows, ripping back above 2,000 after briefly trading near 1,750. In the process, over $550 million in short positions were liquidated in crypto alone. More than $340 billion was added back into the crypto market in less than a day. That's not retail excitement, that's forced repositioning. At the same time, U.S. equities staged a massive recovery. Over $1 trillion was added to U.S. stock market capitalization in just 2 hours. The Nasdaq and S&P 500 fully erased the prior day's sharp decline. The Dow Jones surged nearly 1,000 points to a fresh all-time high. Even more telling, small caps led the move. The Russell 2000 jumped more than 3%, adding nearly $100 billion in market cap, fully recovering from the prior day's dump and turning green on the weekly chart. When small caps outperform large caps, capital is rotating into higher risk assets. That matters. Before going further, a quick note for new viewers. This channel has never asked for money and never will. Anyone using my name to solicit funds is running a scam. This channel is built on factual analysis and real data, not recycled hype. There are plenty of copycats who will spin whatever narrative keeps you clicking. They'll tell you it's moon time when prices are green and doom time when prices are red. That's not analysis, that's entertainment. Real markets don't work that way. We cover both bullish and bearish factors because uncertainty is the only constant. Anyone promising certainty in uncertain markets is lying to you. I only operate under the handle OG John AG on YouTube and X. Now, let's talk about what actually happened. Yesterday, silver printed a low around $65, the lowest point of this correction so far. Today, price surged back to 78. A 22% move in a single day is not normal volatility. That is leverage being forcibly unwound. And if you rely on mainstream media, you'd barely know it happened. This reversal is violent and synchronized across assets. Bitcoin is up roughly 17% from its lows. Ethereum up 18%. Stocks, crypto, metals all snapping back at the same time. That tells us something critical. This was not a collapse in real demand. This was a paper-driven event. Look at Bitcoin over the last 3 weeks. Price fell nearly 35%, dropping from around 90,000 to near 60,000. Yet during that same period, many altcoin to Bitcoin pairs were up roughly 11%. That means higher beta assets were showing strength even while Bitcoin was weak. That's not what true systemic demand destruction looks like. We've seen this same pattern repeatedly throughout 2026. Markets crash and recover, sometimes within hours. At some point, you stop calling it volatility and start calling it what it is. Markets are manipulated. News is manipulated. Narratives are manipulated. But truth always surfaces eventually. Now focus on silver, because this is where the data becomes impossible to ignore. The silver lease rate in London just jumped to 6.1% for 1 month. That single number explains almost everything about the recent crash. This was not a physical demand collapse. This was paper leverage getting flushed. If silver supply were abundant, professionals would not be paying premium rates to borrow physical metal. A 6.1% lease rate signals tightness, not excess. Silver remains in backwardation, and the silver stress index has pushed above 106 and continues rising. When prices are artificially suppressed, physical metal disappears. That's exactly what's happening. COMEX open interest confirms this. Gold open interest recently fell to just over 400,000 contracts, the lowest level since December 2018, down from more than 555,000 contracts only 2 weeks earlier. That tells you speculative positioning has been washed out. As specs slowly return and then rush back, open interest will expand alongside price. Volatility remains, but probabilities shift once leverage is cleared. Now, look at China, because this is where physical reality dominates paper narratives. Since 2020, roughly 6,600 tons of silver have been drained from Chinese exchange stockpiles. That's a 90% drawdown in just 6 years, equivalent to roughly 30% of annual global silver supply. Physical demand in China remains relentless. Combined silver holdings across the Shanghai Gold Exchange and Shanghai Futures Exchange now sit around 850 tons. After a single-day draw of approximately 73 tons, at this pace, there are only about 11 days of silver left before those vaults are effectively empty. Chinese buyers are aggressively stacking physical metal into weakness. As the world's largest consumer of gold and silver, China's behavior has global consequences. This is not a local issue. It's systemic. Now, layer geopolitics on top. Tensions with Iran are escalating. Iran has refused to end nuclear enrichment talks with the United States. New oil sanctions were announced immediately after talks ended. The situation remains unresolved, and geopolitical risk premiums are returning to markets. Historically, that supports precious metals. If you're panicking in silver here, you're watching the wrong time frame. Zoom out. On a long-term chart adjusted for US M2 money supply, the recent pullback barely registers. Silver recently broke out of a multi-decade range. What we're seeing now looks far more like a retest of that breakout than a failed move. Importantly, silver has not even exceeded its 2011 extreme yet, and many are already declaring the bull market over. Perspective matters. Noise does not. This was never going to be a straight line higher. Big moves never are. This is one of the largest wealth transfers in modern financial history, and those are always volatile, emotional, and uncomfortable. Understanding fundamentals makes volatility easier to endure. Strength comes from understanding, not blind conviction. Now let's talk about silver miners, because this is where leverage multiplies. Silver miners are setting up for a potentially explosive move in 2026. While silver recently surged into triple digits, briefly trading above 120 before pulling back towards 70, miners have barely participated so far. Historically, this is exactly how these cycles begin. From 2002 to 2011, silver rose roughly 300%. The top silver miner at the time, Pan American Silver, surged more than 1,500%, roughly 5 times the metal's gain. On average, silver miners deliver about 3 times the move of the underlying metal. In 2025, silver ripped higher, but miners lagged badly. ETFs like SIL often barely matched physical silver. Analysts were still modeling $35 to $40 silver, using outdated assumptions. That changes in 2026. Major producers are about to report earnings. Cash flows will shock the market. A 10 million ounce producer at today's prices is generating dramatically higher profits than just a few quarters ago, in some cases over 1,200% higher. Those numbers cannot be ignored. Analysts will be forced to upgrade valuations. just as they were in gold. Look at gold miners for precedent. Gold rose from around 1,300 in 2019 to recent highs near 5,500. Many gold miners lagged initially, then exploded higher. Agnico Eagle rose from roughly 40 to nearly 300. Silver miners historically lag gold miners, but always enter a catch-up phase. That phase is starting now. There's also a structural constraint most people ignore. Banks do not have infinite balance sheets. Bloomberg has noted that banks' ability to suppress metals prices through paper instruments is limited. When physical demand overwhelms paper supply, repricing becomes unavoidable. That brings us to the COMEX March timeline. There are just over 3 weeks until first notice day. Open interest for March silver sits around 429 million ounces. Registered COMEX silver inventory is roughly 103 million ounces and falling. February delivery rates hit 98%. January deliveries totaled nearly 50 million ounces, more than 7 times 2024 levels. Inventory is draining at roughly 785,000 ounces per day. If even 25% of March contracts stand for delivery, COMEX would need more silver than may be available. If delivery rates match January and February at 50 to 70%, demand could reach 200 to 300 million ounces against just 85 to 103 million available. That's the core risk. Is a COMEX silver default weeks away? Possibly. But we have to be honest about risk elsewhere. Bitcoin history matters. Every major Bitcoin bear market has seen drawdowns of at least 75%. Applying that historical pattern suggests Bitcoin could still fall toward 38,000 before a final bottom is confirmed. Silver and gold have been tracking Bitcoin directionally during this risk-off phase. Bitcoin remains the canary in the coal mine. Today's violent bounce does not guarantee the bottom is in. It tells us selling pressure is exhausted, but confirmation still matters. In mid-December, silver traded at 65 with RSI near 80 and extreme bullish sentiment. Now we're back at 65 with RSI near 30 and extreme bearish sentiment. Same price, completely inverted psychology. Markets can remain oversold longer than most expect, especially during deleveraging events. Gold's long-term structure remains intact. That suggests the broader precious metals bull market is not broken. But silver must hold these levels and build a base to confirm this is a true low rather than a relief rally. Lease rates at 6.1%. Backwardation persists. China draining 73 tons in a single day. Registered COMEX silver at 103 million ounces against 429 million ounces of exposure. These are not signs of abundant supply. They are signs of paper leverage being flushed while physical tightens. So here are the takeaways. Silver just rallied 22% off the 65 low. Bitcoin reclaimed 70,000. Crypto added 340 billion in a day. US stocks added over 1 trillion in hours. Risk-on returned violently. But Bitcoin's historical structure suggests more volatility may still lie ahead. Silver's lease rate confirms this was a paper washout, not a demand collapse. China continues stacking. The March COMEX timeline is critical. Silver miners are entering an earnings-driven re-rating phase with historical leverage. Did we just see the final low, or was this a powerful relief rally before one last wave of deleveraging? The next 3 weeks will tell us. Data will decide, not emotion. Know your time frame. Understand the risks. Invest with logic, not hype.